You've probably seen testimonials of people whose stock market investments resulted in significant financial gains and positive life changes. For your information, many people are currently profiting greatly from the stock market as you watch this video. Everyone has a purpose for getting involved in stock market investing, and to make $1 million, how many stocks would you need? 100 or more? Believe it or not, the Oracle of Omaha is here to show you how to generate millions of dollars, and all you need is just 3 stocks. If you still don't believe, stay on this video and your chances of succeeding in investments will rise dramatically. It is advisable to closely follow people who have gone before you, who have reached the summit of the mountain when attempting to do the same. If you study and put into practice the best investing advice from Warren Buffett, you can earn millions or billions. Undoubtedly, Warren Buffett is the most well-known and respected investor of all time. The famed CEO of Berkshire Hathaway is also well known for his down-home charm and memorable sayings about the art of investing. You don't have to do anything spectacular to invest like Warren Buffett. In reality, the Oracle of Omaha's straightforward approach to investing surprises a lot of novice investors. As a long-term investor, Buffett thinks it's more crucial to concentrate on a company's future potential than its current performance. When outstanding companies are selling for less than their intrinsic values, Buffett invests in them and keeps on to the investments for as long as the companies are still great. He makes long-term investments in businesses with solid management, a track record of growth, and a sustainable competitive edge. By doing this, he takes use of the power of compound interest. Forever is his preferred holding time. Buffett uses the value investing strategy. Value investing prioritizes purchasing investments at low prices compared to their true worth. The basic objective of a value investor is to acquire shares of a firm that are worth $100 for less than $100, ideally for considerably less. Value investors search out and make investments in businesses that have intrinsic values that are significantly higher than the enterprise value suggests by the prices at which the business's stocks are traded. Value investors like Warren Buffett anticipate that as time goes on, the market will fully appreciate an undervalued company, driving up the stock price and generating profits for the value investor. According to Buffett, the most important aspect of investing is figuring out a company's underlying value and paying a reasonable or low price for it. He is unconcerned with the current or projected performance of the whole stock market. In terms of diversification, Buffett is extremely picky. While many investors try to diversify their holdings over a variety of firms and sectors in order to lower risk, Buffett favors maintaining a concentrated portfolio of equities. According to him, diversification can actually erode returns and result in subpar performance. He would rather concentrate his investments on a select group of businesses that he respects and believes in. Now let's learn how Buffett used his investment methodology to 3 stocks that helped him make millions of dollars and how they greatly benefited him. Number 1. Coca-Cola. Starting with Coca-Cola, he invested more than $1 billion in Coca-Cola in 1988 and 1989, after the stock had increased more than 5-fold in the preceding 6 years and more than 500 times in the prior 60 years. Where is the value in Coke? Many asked Buffett when he initially bought Coca-Cola. And why did Buffett agree to pay 5 times book value for a business with a 6.6% earning yield? It's just because he believed Coca-Cola had a terrific value, and he frequently reminded us that price doesn't indicate quality. According to Buffett, the best business to own is one that can employ significant quantities of capital over an extended period of time at extremely high rates of return. Coca-Cola truly embodies this definition. Given that Coca-Cola is the most recognizable brand name in the world, it is clear why Buffett believes it to be the most valuable franchise in the entire globe. Buffett's acute sense of potential and how his investment has ultimately paid off. In fact, his share in Coca-Cola, which is currently 9% owned, has increased to a staggering $24 billion, a $10.2 billion, or a 54% yearly rate in dividends, is what he received over the years. Number 2. American Express. Now moving on to the second stock, when shares of American Express fell from $65 to $35 nearly immediately, Buffett had understood Ben Graham's advice to act swiftly when the stock of a solid business was trading below its intrinsic value. Buffett took a risk by investing $13 million, or 40% of the partnership's assets, in American Express stock. Buffett made a massive investment in this business, putting 40% of the partnership's assets into it. He was certain that the company was strong despite the controversy and that eventually the stock price will rise to the right level. In the meantime, he saw a fantastic chance. But was it really worth close to half of his whole holdings? Over the following 2 years, the price of the shares tripled and the partners made a tidy $20 million profit. Thus, it was a risky move that paid off nicely. The assets of the partnership reached $26 million in 1965. At the end of 2003, Berkshire had more than 151 million shares of American Express stock, or over 12% of the business, with a market value of more than $7 billion, 7 times what Buffett spent for it. At the end of 2022, Berkshire Hathaway held a 20% stake in American Express. Number 3, Wells Fargo. The third stock which gave Buffett fortune was the Wells Fargo and Company. In October 1990, Berkshire Hathaway declared it had invested $289 million in 5 million shares of Wells Fargo and Company at an average price of $57.88 per share. Berkshire then owned 10% of the bank's outstanding shares, making it the bank's biggest stakeholder. It was indeed a lucky choice. The share price rose as high as $86 earlier in the year before falling abruptly as investors flocked away from California banks. At that time, the West Coast was experiencing a severe recession, and some people theorized that banks would be in difficulty because of their loan portfolio's heavy reliance on commercial and residential mortgages. It was believed that Wells Fargo was especially susceptible because it owned the most commercial real estate of any Californian bank. The fight for Wells Fargo resembled a heavyweight fight in the months that followed Berkshire's declaration. Buffett was the bull in one corner, staking $289 million on the value of Wells Fargo rising. The bears in the opposite corner were the short sellers, who predicted that Wells Fargo, already down by 49% for the year, would continue to decline. Berkshire added to its share count twice in 1992, raising the total to 63 million by the end of the year. By year's end in 2003, Berkshire controlled more than 56 million shares, valued at $4.6 billion on the market and $2.8 billion in total accrued acquisition costs owing to Buffett's ongoing additions to his holdings. In 2016, the company's market worth reached a height of $22.1 billion, peaking at $12.7 billion. Buffett sold a good amount of stocks throughout the years, though slowly, and in early 2022, he put a full stop to relations with Wells Fargo and almost all of his holdings as a result of the bank's internal problems, disputes, and a loss of its moral compass. After holding the shares for over 30 years, or 8.6%, Buffett made billions in capital gains and dividend income. What do you think about why these stocks really match Warren Buffett's investment strategies? Well, they were all excellent businesses, which he knew and trusted. Due to numerous factors, the market also undervalued the price, which presented him with appealing prospects to seize and hang on to for the long run. And these equities continue to do well today. See, American Express and Coca-Cola are both regarded as blue-chip stocks, with Coke being one of the most valuable brands in the world. Even though Wells Fargo has recently had some difficulties, it continues to be a major participant in the banking sector. Buffett doesn't pick stocks only based on his expectation that they would appreciate in value this week, this month, or even this year. Buffett invests in equities because he intends to hold on to the companies for the long run. Although he still regularly sells equities for a variety of reasons, he approaches the majority of his assets with the intention of holding them for the long term. A set-it-and-forget-it investment like an S&P 500 index fund, according to Buffett, is one of the finest investments most people can make if they can't adopt a forever mindset with their equities. You'll probably face financial obstacles along the way, as true riches and financial security take years to develop. However, if you continue to make frequent stock investments, you will eventually stand to gain from compound returns. Buffett once remarked, "Someone's sitting at the shade today because someone planted a tree a long time ago," and it's accurate. The seeds of financial prosperity that are sown and nurtured now will bear fruit later in life, providing shade. This shade may be debt-free living, a comfortable retirement, or being able to pay for your kids' college education. Investing can be a challenging endeavor. By applying Buffett's investment philosophies, which have served as a model for many investors hoping to achieve his level of success, can, however, help you achieve success. Give it a try.